In this video, we will distinguish between accounting profit and economic profit and why that is important. Let's start with accounting profit. Here we're not necessarily talking about the practices of accountants per se in the real world. What we mean when we say accounting here is the accounts of a business where there are receipts and invoices for money. Let's say that a business has explicit costs per week of $1,200. What do we mean by explicit costs? This is the monetary payments made for resources that the entrepreneur of a business doesn't already possess. For example, the entrepreneur may have to employ labour, and so pay wages, may have to rent space, may have to pay for raw materials, and may have to pay interest on loans for capital that it has purchased. So capital here, remember, means machinery, tools, equipment, buildings, factories. Okay. And let's further say that the business is doing pretty well. Its total revenue is $3,000 per week. So the accounting profit will be, obviously, $1,800 per week. Accounting profit is the total revenue for a period of time minus the total explicit costs for a period of time. The difference between them is the accounting profit that will appear on the books, so to speak. From the economist's perspective, this is inadequate because the explicit costs are not all of the costs that are in fact experienced by the entrepreneur. Again, we start off with the same, from the economist's perspective, the same explicit costs. Right? There's still, you have to pay the wages and rent and interest payments, so on, raw material payments. But in addition to that, the economist wants to say that there are implicit costs as well. And let's say the implicit costs are $1,000 per week. What does implicit costs mean? It means that the income that the entrepreneur foregoes to run the business. From the economist's perspective, the entrepreneur is not just giving up money to pay for land, labour, raw materials and capital. They're also giving up money that they could have earned doing something else. Now that might mean, for example, the entrepreneur, instead of running this business, could have been working for someone else earning a salary of, say, $1,000 a week. Or alternatively, the entrepreneur might already own the premises in which they want to run their business. Now, they could rent that premise out and, say, earn $1,000 a week in rent. But because they're using their own premise to run their own business, they are foregoing or giving up, say, $1,000 rent. Or maybe, alternatively, the entrepreneur might have a stack of money which they could invest in government bonds, for example, or corporate bonds, or something like that, or long-term deposit accounts with the bank. But instead, they've used that wad of money in order to purchase, for example, equipment. So they have foregone or given up the interest which they would have got on for holding bonds or whatever. So this is money which is given up by the entrepreneur. The economist says this is a cost of running the business too. It's a cost to the entrepreneur. The entrepreneur, therefore, has to be compensated for giving up this income in order to run their business. So these implicit costs could be thought of as the salary that the entrepreneur has to pay themselves to make it worth their while to run the business. Furthermore, a little piece of terminology, we can say that if the revenue from running the business covers this implicit cost, we call that normal profit. Although strictly speaking, it's not really profit in the sense that it's in fact a cost that the entrepreneur is simply being compensated for. Okay. Then we can say, okay, so we've got the explicit and the implicit costs. And we've got our total revenue. Now the total revenue is, as we saw before, it's $3,000 per week. So, from the economist's perspective, how much profit is being generated? It's $800 per week. Economic profit. Economic profit is also sometimes called supernormal profit. That is, profit over and above the quote-unquote normal profit. As you can see, these two profits, accounting profit and economic profit, are not identical at all. Economic profit is smaller than accounting profit because the economist counts implicit costs for which there are no receipts. The accountant, or in accounting terms, we don't count those implicit costs as costs because there's no receipts for them. Okay. You might say, well, that's all very interesting, but it doesn't really have any impact on whether the entrepreneur is going to run their business or not. In both of these cases, whichever way you slice and dice it, the entrepreneur is still making a profit, whether it's $1,800 accounting profit or $800 economic profit. So you might say, well, it's a distinction which doesn't really make a difference. Well, not true. Let's imagine a different scenario. Let's say the entrepreneur is buying the same amount of resources, land, labour and capital, as before, and so they have explicit costs of $1,200. But let's say that for some reason or other, there's been a fall in the entrepreneur's revenue suddenly. And so now the revenue being earned is $2,000 a week instead of the original $3,000. In this case, calculating accounting profit, total revenue minus total explicit costs, gives you an accounting profit of $800. Okay, so the business is not doing as well as it was before from an accounting perspective, but it's still making accounting profit. From the economist's perspective, however, we need to add the explicit costs of $1,000, that which has been foregone, the income which has been foregone by the entrepreneur in order to run this business. Now we compare that to the new lower total revenue. We can see that the total revenue now doesn't cover the explicit plus the implicit costs. In which case we would say that the firm's or the business's economic or supernormal profit is negative $200 per week. Or, in other words, the business is making an economic loss of $200 per week. Now this is a case where we can say that the difference between accounting profit and economic profit matters. And it matters because of the decision that the entrepreneur now has to make. The economist is going to say, okay, so you gave up $1,000 to the entrepreneur. You gave up $1,000 to run this business. That is, these are your implicit costs. You gave that up, $1,000 a week. to run this business in order to make $800 accounting profit. Now, that doesn't make much sense. You gave up $1,000 in order to make $800. You're losing money. It's not rational behaviour. In which case, you should consider the possibility of shutting your doors, at least temporarily, maybe, or leaving the market in the long run, and we'll see what the long run means in a minute, leaving the market altogether.